is the second topic in this marketing and sales component. And this is probably one that most people are most interested in, is price, because it asks and answers one of the basic questions that anyone in business has to figure out. And that is, how do I put a price on whatever I'm selling? What is a process that will most likely give me a price that the customer is willing to pay and I will make the most benefit on? That's really what you're at. So this process is not as simple as, well, it's not complicated, but it requires some degree of thought. And there's a process to it that if you follow, it will help you determine a good price for any of the products you have. Tonight, what we're going to look at are these basic concepts. What factors are going to come in that influence our pricing? Do we charge a higher price or a lower price? That's what we mean by influencing our pricing. We're going to put a price on it, but is it on the higher end or the lower end? Where are we to? Once we've done that, then we got to think about our basic policies, like in terms of how much credit do we give? How much leniency do we give if someone buys 6 off you as opposed to 1? These sorts of things. And the issue of services. How in the heck do you put a price on something you can't see? So, first of all, you have to understand what price is. And price, by definition, is the money or other consideration. So it includes barter. So if you do something for me, I do something for you, that's effectively a price, a barter. And this money or other consideration is exchanged between at least 2 parties. There could be more parties involved, but at least 2 parties, in return for the ownership or use of a good or service. So what you're going to do is you're going to say, okay, I'll give you $100. You'll give me a load of wood. Okay, so exchange the $100 bill for a load of wood, that sort of thing. So we got to think too that the more you buy or the more you sell, the more money you'll make. So price is a function. Price will be a function in the total sales revenue that you have come in. So if you sell 6 loads of wood for $100 a load, that's a $600 revenue. So we have to think about the fact that the price you charge times how many you sell will give you a total revenue. Okay, and calculating total revenue is pretty straightforward. We want to be able to multiply the price we charge times the quantity we sell. The thing is, though, it's nice to be able to say, okay, that's good. You can sell 6 loads of wood for $100, $600 revenue. But what if it costs you $700 to get the wood that you're selling for $600? That's not a very good process, is it? Because you're actually losing money in that deal. So you need to think of yourself, to think of this process yourself before you actually work through it, so that you ensure that you actually make money, meaning the price you charge times how many you sell will give you a revenue that is greater than the cost of actually producing the product. So here's the simple calculation in order to do this, and we've seen this many times before. Price times quantity is total revenue. The revenue less the expense of producing the product that you have will be your profit. And if you don't make a profit, you're making a loss or breaking even. So it's just simple math, but we need to be able to get it in our heads in terms of how this basic process works. Now, we also throw in a concept of the term value, and skilled tradespeople need to be aware that they're providing value. And value has a limited amount to do with the price. Price works into value, but if you consider, for example, if you're providing a service, say machining, and you're an expert machinist, the value that you bring to it is your expertise. So besides the raw materials that you're producing or the actual product you're producing, that expertise that I can't make it, I can't do it. So you're providing value to me. And that value is important to the customer. So what you need to do in order to, when you think about putting a price on something, is ask yourself, how much value am I providing the customer on this? Now, if you're still not clear on the basic concept of value, all you got to do is look at 2 sets of drill bits, okay? So here we got a basic set of drill bits that you can buy at Canadian Tire. This is 200 drill bits, 230 drill bits, and you can buy it at Canadian Tire today for $40. Now, this Milwaukee Tool Cobalt Red Helix drill bit, it's a much higher quality drill bit, meaning that it will cut a lot more holes without getting blunt, is about $160. So, you know, that's 4 times as expensive for fewer drill bits. And you got to ask yourself, well, you know, if we look at price and price alone, go buy the Mastercraft. You know, it's the cheaper one. There's the simple solution. But the reality is, if you're a machinist, you know that buying a cheap drill bit might be good on the front end. It's a low cost. But if you have to go through 6 of them for every one of the other, you're not really getting a good deal. You know, these ones on the right are 4 times more expensive. But on the other hand, if they last 6 times longer, the cost per hole or the cost per use is less. In other words, even though the absolute price of the Milwaukee drill bits in this case is more expensive, the value you get from them is greater. So value is the ratio of the benefit compared to the price. And whenever you provide a product or service to a customer, you got to think about what is the value you're providing and how can you demonstrate that value to the customer. So pricing needs to factor in how much value. Now, if we think about, okay, we got to understand this concept of value. We got to understand the concept of putting a price on it. What is the price that we put on? You know, where does that number come from? Well, it really depends on you because you're selling the stuff and you need to determine what is it you want to achieve here. So let's think about what you want to achieve. First of all, internally, there are some things that you need to think about. You got to think about your business objectives. What is your objective here? Are you a charity? Is your job to provide services at as low a cost as possible to your customer? If you're a charity, that's going to bring your prices down. However, if you're a for-profit business and you need to be able to feed your family and feed yourself and buy the things that you need to be buying, you need to charge enough that the expenses are less than your revenue. And that gap between the two will provide you with enough income to keep you in the business that you're in, because you could do something else, keep you in the business that you're in, and be able to give you a decent lifestyle. So you think, if my business objective is to make money and profit, my price has got to be on the higher side. If my business objective is to be a social enterprise or a charity, my prices will probably be on the lower side. So that's going to give you a range. We'll call a range of prices, the high end to the low end. We also think about how much does it cost to market this stuff? Does everybody know you're there? Do you have to do a lot of promotion? Do you have to do a lot of research into customers' needs? Do you need to do all the things that we talked about last week? And that takes time, energy, and effort. That got to be factored into your price because someone's going to pay for that. That's your time. Cost of the raw materials. And again, that's pretty simple, isn't it? If you're buying product to make something, if you're buying a sheet of steel, for example, or some cold roll steel, someone's got to, you know, you got to make more on it getting rid of once it goes out the door than what you paid coming in the door. So if the cost of materials are high, your prices are going to be higher. If the cost of materials is low, your prices can afford to be lower, but you got to get enough to cover the cost of buying the raw material. And this is a real problem right now. You know, when the cost of raw materials have gone up, your prices would need to reflect that. The type of product you're building. Is it a common product? Is it something that there's lots of competition for? If you're making stuff that everybody else has, you got to keep your prices on the lower side or provide some extra value somewhere or another. If your product's a unique product that is one of's, you're the only ones that make it, you can charge a higher price for it. How the product is distributed. Do you need to ship this product far? Does it require expensive shipping charges? Is it right next door to you? You know, what does it cost to distribute that product? Is it expensive or not so expensive? Again, that needs to be factored into your price. These are internal issues. We also have external issues. What's going on out in the world? What is the demand for the product you're selling? If there's a really high demand for it, you know, people want whatever you're making, and wow, there's huge demand, you can afford to charge a higher price for it. If the competitive environment is that there's no competition, no one's competing against you, you're the only game in town, you can charge a higher price. If there's lots of competitors, you got to keep your prices on the lower end in order to compete with them, at least on par. What are your suppliers doing? Are there lots of suppliers? Do you have lots of supply choices? Limited supply choices? Are the supplies expensive? Do you have a lot of control over how much you're paying for your product? What type of customer do you have out there? Is it a customer that's really concerned about price, or is the customer more concerned about the quality and the value that they get? If your customer is more concerned about the quality and the value, higher pricing is on the go. If customers are very concerned about the bottom line, well, that's going to affect your ability to charge a higher price. The economic environment. Are there lots of buyers out there for your product? Lots of people with lots of money to buy it? If there is, higher prices can be charged. If there's not, lower prices. Government policies. Sometimes you're regulated in what you can charge. You got to sell gasoline, for example, at the maximum price. In most of the products that we sell, government regulations or government policies with regards to the price is not necessarily there. But there might be other policies that government has, such as laws. If you're an electrician, you're installing electrical cable, for example, and you need 12-gauge wire. The regulations say you got to use 12-gauge wire on this type of circuit. That's a more expensive wire. You're going to have to install that. That's going to reflect in your prices. So government laws and regulations are going to play into that. The legal environment. Maybe legally you need insurance. You got to buy these things that jack up the price of your product. And the influence of the manufacturer. Is someone pushing prices up on, the manufacturer that's manufacturing the product for you? Are they charging higher prices, so you got to charge higher prices, or maybe they give you some discounts so you can charge lower prices? So effectively tonight, what we're looking at then is that's the philosophy of it. Now this is the practical side of it. So if we think about the practical side, in order to put a price tag on something, so here we got an item, let's put a price tag on it. How much do we charge for this? Okay. Well, if we're the Apple company and we're selling iPhones, we need to think about these in turn here. And the first one is this basic issue of what's called a pricing constraint. And we've already talked about pricing constraint in that generally what you want to sell that for, because your cost structure, how much it costs to put up a factory, how much the materials cost to get inside of this phone, whatever the components are, your labor costs, shipping costs, these sorts of things. You'll have a good idea of that. You also know that you're going to have a market for 1 million of them, or 2 million of them, or 10 million of them, or 100 million of them. So you got to be able to think about, okay, the market is this big. That's the quantity that I can sell. The general costs of producing the product is whatever, based on my assessment of the inputs. And you're going to say, well, okay, this is the very minimum that I could charge for that product, and because that's what would be basically the cost to make the thing. Okay, so there's a bottom end on your price. The top end on your price is really going to be dependent on how novel is the product, how many people are willing to buy this at a higher price, how many people are out there wanting this, and if there's a big demand for it, a little competition for it, you can charge on the higher end. So again, you're kind of doing this initial assessment here in step one to say, here's the minimum price I can charge, and this is what I figure is the maximum price I can charge. So you've got a lot of light between where you think you could charge if you pushed it versus what you must charge in order to keep surviving. So you're going to set your price somewhere between this higher and low part. So in this first phase, you're thinking about, okay, what are some of the basic constraints? What are holding me down in terms of keeping me from going above that price? We got to think about the demand for the product. How many units could we possibly sell? We got to think about, this issue of brand recognition. How valuable is the Apple name and people buying it? Do they associate it with quality? Is it a relatively new product? Is this the new iPhone or is this the old iPhone? If it's the old iPhone, people aren't going to pay as much for it. It's a single or a multiple product, meaning is this the only phone we make, or we make 20 other different kinds at different price points? Because if we make 20 other times, maybe we can make up our revenue somewhere else. If it's the only game in town, you're kind of limited with regards to what you can do in terms of price. So the constraints are that really kind of max us out and say, this is the most we can charge for. In step 2, we're thinking about, okay, we know this maximum. What about our objectives in order to kind of get us into this range that we have? You know, the minimum is really our cost of producing it. The maximum is based on our constraints. So we're kind of narrowing down this gap between what we think we can get maximum and what we know we have to have minimum. So we're looking for somewhere in between here. So in the stage 2, we're really saying, okay, let's make that a little bit finer in terms of that whole. So we're asking ourselves, what are our basic objectives here? If we're selling these phones, what do we want to do? Do we want to maximize our profit? Do we want maximum sales revenue? Keep in mind, profit now is revenue minus our expenses. This is how much money we make at the top. And sales revenue is just how much money we draw in, okay? Some companies want to maximize their revenues because it looks good politically, or, from a marketing perspective, it's going to say, we had $100 million in sales. Now, you might have had $101 million in the expenses, and you're no better off. But sales is often a goal that companies have. Let's do $100 million in sales of these things. So maybe sales is what's driving it as opposed to profit. Market share, how much of the total market? So if there's 20 different cell phone manufacturers, you want 90% of that market. What kind of price point do we need in order to get that 90% of the market? Are we hoping to sell a lot of this stuff? Are we going to flood the market with these things? Or are we just going to have very select? You know, do Rolls-Royce flood the market with Rolls-Royces? No, they're into the one-offs. They make their money on few. General Motors want to get a lot of Cobalts or a lot of Chevy Cavaliers out as fast as possible. They tend to charge on the lower end because they want to keep the market full of them. Maybe you're into customer value. Maybe you're really into customer value and you want to get that. You know, if we think about the Tesla company, certainly wants to provide that customer value. We want a high-end car that allows it to drive X number of kilometers on a charge, and we want it to charge up quickly. You know, customers might value that, and that's the thing that we want to keep our prices so that it meets what customers feel is the value they have. Are we being socially responsible? Is there some sort of a social cause that we're doing here? Maybe a lower cause, you know, like Habitat for Humanity houses want to be the lowest possible price so we can get people who have limited means into those. Otherwise, we could take this worst case scenario where we need to charge a price so we can survive. That is, we make enough money to pay our bills, but that's it. And some companies in desperate times need to charge just enough to cover their basic expenses. The airlines during COVID, for example, had to keep the planes flying. They needed to charge enough just to pay the basic bills. So once we've kind of got an idea of the top and bottom, and we kind of try to narrow it down a bit, we start doing a little bit of math with regards to this idea of what impact is the price we charge on the item, on the higher or lower end, going to have on how much of the item we actually sell. So the connection between our price and the quantity we sell. So in this step 3, we want to find out what is the potential demand for this product anyway. Okay, how many units can we sell, basically? So we're going out to do our market research, which we talked about in the first section there, to find out what is the potential market for this. If we know we can sell 1 million of these, or 100 of those, or 20 of those, that's going to really tell us, if we charge this price times the number that we anticipate in selling, there's our total revenue. Is that enough revenue? Does that cover our bills? Is that feasible? That's going to help put a very fine point on what is the price that we need to charge over here. So, you know, the product itself is going to have a price to it, and also the buzz around the product, which is factors other than price. You know, consumer tastes, customer income, availability of other similar suitable products. You know, if customers have a lot of money to spend, if there's lots of substitute products, that's all going to impact how much we really need to charge. So we need to think about how many can we sell, how many, and then we'll adjust our price to make sure we sell that number. So in this step 3, what we're really putting a pinpoint on when we actually do this is to say, okay, look, if we could estimate how many we could sell at a given price, because if you think about the basic law of supply and demand, the basic law of supply and demand says, look, the higher the price you charge, the fewer the items you're going to sell. Demand will drop if prices are high. And you think about it yourself, something's really high priced, you're probably not going to buy it as easily. The lower the price goes, the more easily you're going to buy it. So demand goes up with price going down, and down as price goes up. We can find the magic number. And the magic number that we look for in this demand quantity thing is called a break-even point. And a break-even point is the point at which we actually start making diddly squat. Well, it's the point at which we stop losing money by selling a product because we're not selling enough of them, and we actually start making money. So it's this magic point when we do not lose any money selling the product. And the break-even point is a pretty simple concept that we need to think about how many units of a given item that we sell do we need to sell in order to be able to make any money. Is this worthwhile? Is there enough demand for this product to make it worthwhile? So let's assume, for example, that whenever we sell things, we got to buy a certain amount of equipment in order to make it. And that certain amount of equipment could be used right across all of the production. In other words, the cost on that equipment is fixed. There's fixed cost on that production. We're going to also have the cost to make each unit. So we got two separate costs. We got a fixed cost, which is the cost of to make all the gear. And we've got the cost to make each unit. Okay? If we know the selling price, we can figure out the break even. So here's a little bit of the way that this works out. If we took our fixed cost, how much we have to pay in order to make all of these products, costs that do not change regardless of how many we make. We take our fixed cost and we divide it by the difference between the selling price and the variable cost. All this means is this is how much we're making on each unit. We sell it for $1, it costs us 70 cents to make, we're making 30 cents on each unit. Or in my example here, if we had a selling price of an item of $1,200 and the materials that went into it were $700, we know then that $1,200 minus $700 is $500. So we make $500 on each unit. We make $500 profit on each unit. However, because it's a $100,000 setup in order to set the factory up or do whatever, we have to figure out how many do we need to sell before we actually start making money. So we took this 100,000, divided it by 500. We will quickly find out that we need to sell 200 units. 200 contributing $500 each is $100,000. So once we sell 200 units, we're going to cover off this $100,000 cost. When we sell 201 units, we're going to have this all covered off. 201 units going to create $500 profit. 202 units going to create another $500,000 profit. 200, as we keep going, each additional unit above the break even will contribute an amount of profit. So if we're in this business here and we got these hypothetical numbers, if we cannot sell 200 units, let's not bother to make this product because we know that it's going to cost us $100,000 to set the production up. We know that it's going to cost $700 in materials for each one. And we know that our planned selling price is $1,200. So we're making $500 on each one of them. We know we got to sell 200. Now, we could adjust our price. We could bring our price up or down, but bring our price up or down, we got to remember, will affect how many we're going to sell in terms of the quantity. So we need to determine whenever we go into making something what the break-even is. And the break-even will tell us realistically, can we make 200 units? If you don't have the capacity to make 200 units in a year, for example, this has to be in a space of time, and you require 200 units in order to break even, you're just losing money. So you need to either charge more for the item or make more items, find a way to make more items. Once we've kind of figured out the break-even, we know we got to sell 200 units. We know generally what the top and low price is. We can put even a finer point on it by thinking about what's called a price level. So these are potential prices that we can put on a product. And price level is really some points that we are going to determine which of those points we want to sell it for based on, do we want to sell a lot of these? Market penetration pricing says we want to sell a lot into the market. We keep our price on the lower end. Economy pricing, keep our price on the lower end so people get more value. Premium pricing, we keep our price on the high end. If we want to, like Rolls-Royce would do, to create a premium price, to create a, not everyone can afford this type of thing, right? Psychological pricing is when we charge $99.99 for it as opposed to $100. Again, it's a higher price, but in people's minds, it's $99 as opposed to $100. Bundle pricing is when we sell a number of items together. So here's item A, B, and C. If you buy 3 of them as a package, you get a better deal. That's bundle pricing. So we can think about, if we're making products, if we sell 2 products to a customer, we can charge less for it. Geographical pricing is pricing depending on where we are. If we got a cost built into our product of shipping this product out, if someone's really near to us, maybe we can charge a lower price to the people who are not so far away because it wouldn't cost as much to ship. If they're further away, we charge them higher prices. So basically, we just add shipping to the cost of the pricing. We also have price promotions, buy 2, get 1 free. That sort of thing is an example of price promotion. We got to be careful with that because it cuts down our margin, how much money we make, but it encourages more sales. We can also think about seasonal pricing. If we're selling snow blowers, for example, we lower the price in the summer. People will buy them in the summer, even though they're not going to use them, but we'll get revenue come in, and that will help our cash flow. So the idea is that we lower the price to get people to sell, get people to buy it early, and that way we got money coming into our coffers. You think about White Hills. White Hills sells season passes early. Early bird passes are sold at a lower price. The idea is that the Hill gets money come in early to get things started, right? So we will take a lower price to get money come earlier. Value pricing is effectively lowering the price so people get a higher degree of value. Captive pricing means we're the only game in town. You got to buy from us, charge a higher price. Experience curve pricing is an interesting one for a lot of manufacturers. You know yourself. I know, Harrison, you built a piece of equipment last week. In order to make a unique piece of equipment, it takes a long time to do, okay? Because your trial and error has to come into it. Now, if I asked you to make another one this week, you made the one last week, you've learned the lessons from last week, you could probably do it twice as fast. And if I asked you to make another one next week, you probably do it even faster again. So effectively, the first one takes a lot of time. As you move down to the second one, it doesn't take as much time. Third one doesn't take as much time again. Fourth one, the 100th one takes even fewer time. So effectively, as we get used to making it, the amount of time and effort to get it made drops. If you got a CNC lathe, for example, once you got the thing set up and programmed, right? So experience curve pricing comes in there. The first one is always the hardest one to make. And sealed bid pricing is just a tender. So basically, you, in terms of pricing, is you submit a price, I submit a price, it's in an envelope. On the day that the bids are open, the company that's buying from us opens your envelope, opens my envelope. If it's the same basic item, they just pick the lowest price. So normally what companies do is, because of these pricing changes depending on, we create what's called a list price. And the list price is just a paper price that we put on certain products. So for example, here's a company that does publications. Depending on what you want produced and how many you want produced, this would give you the degree of how much it costs. So in this particular instance, the 1 unit, for example, if you're a member, like in Costco, you get it for $57. If you're a non-member, you get it for $69. So again, a list price that applies to one type of customer and another type of customer. Sometimes we have volume discounts where, for example, the more you buy of a given product, the lower the cost per unit becomes. So normally we talk about our highest price and our lowest price. We establish a list price, which is what's written down. When I come in, though, you might give me a better deal than the list price because you might make special adjustments. So what would constitute special adjustments? Well, this is really what we call flexible pricing, and these adjustments are usually based on who the customer is. If you're a good customer of ours, we'll give you a better price. If you're a brand new customer, you only bought once from us, we'll give you a higher price. If you are a supplier to us, we deal with you a lot, we give you a different price. Maybe this customer is a really good customer, buys lots of product, lower price. These sorts of things come into that. And again, how much competition there is going to affect that special adjustments in the price. And special adjustments are usually based on quantity discounts, seasonal discounts. As I say, if you buy it early in the season, you get a lower deal. Trade discounts, meaning that we're in the same business. I'll give you, if you're a supplier of me and we buy products together, I'll give you a better deal. You're in the same business as I am. A wholesaler, for example, will provide a lower price to a company. So if Eastern Machining went out and bought some steel from a company that you normally buy from, they'd get a better deal on it than I would going to that company because Eastern Machining buys a lot more, and it's basically they're in the trade. And cash discounts. Cash discounts come into play with a lot of pricing too, because if you pay cash, there's no hidden cost with it. If you pay credit card, if I'm selling it, I got to pay a 2% fee to the credit card company. So right off the bat, I'm losing 2% on that. So if I give you the deal at 2% because you pay cash, it gives you a benefit, and I work out the same. So, a cash discount is just an incentive to pay cash. Sometimes, too, we can make these special adjustments in terms of providing allowances. If someone's building or buying something and you are trading something in, or we give you a promotion, meaning you buy two, get one free, that sort of thing, or if you're close by, geographic adjustments, these come into play in terms of depending on the product. And we see different types. This is just you pay the shipping price or they pay the shipping price. Now, what we looked at here then is just variations in price, variations in the fine point of the price. Okay, we pick the top, we pick the bottom, somewhere in the middle, and we say, where are we floating in here? And sometimes we can make special adjustments in terms of that float, depending on who the customer is. We got to be careful doing that because we can run into some legal difficulties. For example, fixing price, driving up prices to drive people out of the market is illegal. Price discrimination, if you don't have a good reason for charging me a different price than someone else, you could end up in court, as price discrimination, you're discriminating against me. Or deceptive pricing, when I show you a price, I'll do that for you for $100, but I end up sending you a bill for $300. Why? Because I didn't tell you it was 3 payments of $100, that sort of thing. That's what's called deceptive pricing. So that's really the pricing process. It's a stage thing of finding the high, finding the low, and finding this best price that's in between that. Now, we can do a simple example of that here by looking at someone building sheds. If you're in the shed building business, what are the pricing constraints? Well, the basic pricing constraints in this is the wood, the material that you put into it. A shed like this, for example, is going to have $1,300 worth of wood in it. Okay, right off the bat, that means that you got to charge at least $1,300 for it, and even then, you're not factoring in your labor costs. But it's $1,300 wood, but it's also 10 hours of labor at $50 an hour. Okay, so that's $500 worth of labor. So you're going to have to charge $1,300 for the material plus the $500, so that's $1,800. So you're not making any money on it. You're not making any profit on it by selling it for $1,800. So this would be basically your pricing constraints. In other words, you got to charge more than $1,800 for it. Okay. what are your objectives here? If you want to make a lot of money or sell a lot of product, if you're brand to the market, you want to entice customers to buy from you, you might want to charge as closer to that $1,800, so you're not making a lot of profit on them. But if you know you can sell a lot and you're making, say, $300 on a shed, that might be enough. $2,100 might be enough. If you know you're not going to sell too many, maybe you want to charge more than that, because you got to make more in order to give you the revenue that you desire. We estimate the demand, in terms of how much you want to make. Do you think you can sell 10 of those sheds, 20 of those sheds, 100 of those sheds? If you got a production line, maybe you can make one every day. If you can afford to charge on the lower end. If you can't, you got to charge on the higher end. So your price level is going to come in somewhere between your highest potential price and your lowest. And then you're going to make some adjustments, as we just talked about. Are you in the trade? Are you doing it for someone? They're buying it out of season, or they're buying it early, or they're going to pay you cash. All of these things that we talked about that could influence and bring down or draw up the price. So this is the basic concept that we have whenever we talk about pricing, is working through this process in your head so that you can put a price on it that will give you A, enough revenue to cover your costs, B, enough profit to make it worth your while, and C, provide enough value to the customer that the customer will say, yeah, I got a good deal out of that and I feel good about it.